So the bank or the creditor is really the one that has power in this whole transaction here in regards to the contract. When the lender or the borrower, the debtor, comes to them and says, "I can't pay," the bank can say, "Okay, I'm going to force you into bankruptcy. I'm going to take the collateral on whatever assets I have, and take the assets and be done with you. I could take the equity or give me some ownership in your company, like we just went through in the first part of the problem." Or they could just modify the terms and say, okay, if you can't afford the payments as we have them structured now, what if we reduce the payments or reduce the interest or some other format of making the loan manageable for the borrower. But what's most likely to happen, I don't understand why a bank would want ownership of a failing company. That just doesn't seem like a winning proposal for the bank. I mean, they're in the business to lend money and to get it back. But now they've got a loan that's gone bad, and that's part of the business, is how do you deal with those loans. And most likely the bank has some form of collateral or a mortgage on something. And in this case, we'll say that the bank doesn't want ownership in this failing company. Rather, they want um, that some of the assets, so they can take the asset and sell it on the open market to recover some of their loss or some of the loan that's owed to them. So here we're told that the the, the bank is going to go to the debtor and say, hey, that piece of land you own, let's take that. If you give us that piece of land, you don't have to pay us any of the um, interest that you haven't paid or the outstanding loan obligation. And the loan, um, not the loan, the land in this example has a fair market value of 342, and it has a carrying cost, a value of 324 for the debtor. So that meant when the debtor bought the land, they put it into their records at the cost, following the historical cost principle that we use in accounting. So this is what it would look like on the books of the debtor. And the bank's going to get the land. So they're going to put the land onto their records at some value. So the question becomes, do they simply take the basis or the cost value of the debtor and push it over to their records, or do they use the fair market value? I think when we're looking at debt settlement in terms of exchanging assets, it's easier to start with the creditor because it's fairly logical what we do. And the first thing we do is we've agreed to eliminate the loan. We're going to take this land in full payment or full consideration of the loan and any outstanding interest. So logically, the value of the loan or the note receivable is nothing when we're done, and the same with the interest. It's nothing when we're done, and we're going to book the value of the land at the fair market value at the time we receive the land. And so the value we're going to assume is 342, because the problem here tells us it has a fair market value of that. So that becomes our cost or cost basis in the land. So if we look at what just happened here, we debit this land, we're the creditor now, for 324. We debit the note receivable for the 300, and we credit interest receivable for the 66,000. But that wasn't enough, right? We were owed 366. We only got something worth 324, and so that to us seems like we got the raw end of the deal. I mean, we're going to recover some of our losses by reselling the land, but we gave up value of the loan in exchange for something that we could grab onto and make sure we get. So when we record the difference, debits have to equal credits, right? So we're 366 over here and 324. So if I do the math right, that means we're $42,000 shy of what we're owed, and that again goes to this allowance for doubtful accounts. And that's what the creditor does. They recognize this loss using the allowance method, and but they received the asset of the land. So that's what the bank does. The debtor's side of the transaction is a little less clear. Students seem to struggle with this more. What logically is going to happen, though, is the bank has agreed to forgive the loan, so the note payable goes away along with any accrued unpaid interest. So we're going to debit those things, and our land is going to go away. So let me just start building this journal entry. Note payable. Just format this quick. And we have the interest payable. are both going away. Right? Debit that for 300,000. We're going to debit this for 66,000. You probably didn't have a problem with doing that. Now this transaction is broken into two pieces. First, we're disposing of the land, so we're giving it back over to the bank. So it goes away for 324. So we could also credit land for our cost. But now the question becomes, what do we do with the difference between our book value and the fair market value? Well, the way we account for this is we break it into two pieces. First, we say one thing we did was we had some debt forgiven. So there's going to be either a gain or a loss on being forgiven that debt. And the second thing we do is we have a disposal of some asset. And those are two separate transactions. So the argument is this, that we disposed of this land, we got rid of it, and in exchange for the disposal of that land, we received the fair market value of the land. And so the difference between the fair market value and my cost, so the fair market value was 342. If I take the difference between the two, $18,000. So when I disposed of the land, I gave up something that had a value of 324, and in exchange I was receiving the fair market value. So the disposal of the asset is an $18,000, looks like a gain, right? Because the thing went up in value. So I have to not debit. Remember, a gain is a benefit to the income statement. So we credit gain on asset disposal of the land, for the difference between the fair market value and the book value. Okay, so now if we just stopped there, you could add your debits with your credits, and you'd see that the credits are smaller than the debits, and the difference between the two is $24,000. Okay, now this is fairly logical, I think. What's going to happen is we're getting the relief of the debt, 366, in exchange for what it amounts to the fair market value of the land, the gain plus my cost basis of 342. And so there's a $24,000 difference, and that $24,000 difference is the amount of debt that we were forgiven. And so the $24,000 is going to be also a gain on debt settlement, or restructuring of debt, or something like that. And if we do that, then what you'll see is 366 matches 366, but it's important we break it into the two components, because the gain came from two different parts. One is the gain on debt settlement, and one is gain on settlement of land. And the reason that's important really probably goes beyond the scope of what we're learning about here in debt settlement, but there are tax implications of that. Perhaps, depending on whether this is a corporation or an individual, this could be a capital gains tax. Here in the gain on debt settlement wouldn't be. It'd be recognized as ordinary income, and they're taxed at separate rates. So separating out the gain is really important, and so that's how you do it. Make sure you have a good understanding of, if we're the debtor, we break it into two parts, and how those calculations work. The gain or loss on sale or disposal of the land is the difference between the book value, what's in our books, and the fair market value, and then the gain or loss on debt settlement is the difference between the carrying value of the debt and then the fair market value of whatever we're giving up in exchange.